Hello everyone, welcome to this channel. This is Dr. Ambuli, Associate Professor, SR Institute of Science and Technology, Chennai. In today's video, we are going to learn one of the most important topic in financial statement analysis, that is profitability ratio analysis. This profitability ratio help us to understand how efficiently a business earns profit, and also we can say this topic is very important to understand the real-time scenario of the company. So we'll move on to the profitability ratio analysis. So we'll start with the title profitability ratio. What is the term profitability ratio and definition of profitability ratio, and what are the different types of profitability ratio and how you can compute the profitability ratio. So these are the uh, content we are going to discuss in this video. So first we'll start with a meaning. What do we term profitability ratio? So when under the different type of ratios, we have discussed in the last video, the one of the type is profitable ratio. In continuation with that only, we are going to discuss what is profitable ratio. Profitable ratio or the one of the financial ratio that measures the ability of the business to earn profit from its operation. So the business are continuously um, operating their activity. So by doing this activity, what is the ability of the business to earn profit? That can be find out with the help of the profitable ratio. In a simple term, the profit ratio shows how well a company convert the turnover or sales and investment into profit. So when you calculate the profitable ratios, it includes the following. So these ratios indicate the operational efficiency of the business, and what is the financial performance of the business, and what is the long-term survival ability of the business. These three can be identified by calculating the profitability ratios. The next one will move on to the definition of profitable ratio. So the financial expert defined the what is the term profitability ratio. So profitability ratios are those ratios which measures the earning capacity or earning ability of the business in relation to the sales, asset or capital employed in the business. Or simply state, the profit ratio indicate the success or the failures of the business in generating the adequate returns. Returns always says about the profit. So when you say about the profit ratio, it represents about the profitability earning capacity of the business. The next, we will discuss about what are the characteristics while calculating the profitability ratio. The following are the characteristics or the features involved in profitability ratio. The first one, it focus on earning capacity. When it says a profitability ratio, it always denotes the profit generating ability of the business. The next one, important characteristic of profitable ratio is nothing but the based on the income statement and balance sheet, we are going to calculate this profitability ratio. So the profitable ratios always is the most of the ratios profitable ratio we are calculating based on the income statement, income and expenditure statement, or we can say the trading and profit and loss account. The next, the characteristics of profitability ratio is nothing but indicator of business efficiency. So when the profitability ratio shows the higher percentage, it says about the efficiency of business is high. When it says about when the profit ratio shows the uh, less percentage or moderate percent, in this case we have to concentrate on the reduction in the cost, or the expenses. So it always indicates the business efficiency, how the business efficiently is running. The next important characteristic says about the useful for the long-term analysis. So profitable ratios help in evaluating the long-term financial viability of the business. Um, the The next important characteristics is important for the investor and management. These ratios are closely watched by the following stakeholders: shareholder of the or the investor of the business, the management, the financial institution who are lend money to the business. So these stakeholders are very much keen about the profitability portion of the business. Then next we'll move on to the what are the different types of profitable ratios. eh, in the while using the ratio analysis. So while discussing about this type, we are going to discover what do you mean that, how to compute the based on the formula, what is the ideal standard we have to maintain, and how you can write when you are using the real scenario. The first profit ratio we are going to discuss gross profit ratio. What do I mean the term gross profit ratio? It always shows the relationship between the gross profit and the net sales. So gross profit can be derived by using a formula. It's nothing but opening stock plus purchases plus all direct expenses minus closing stock. By using this, we can able to find out what is gross profit. Net sales refers to the sales minus the sales return or return inward. So by using these two variable, we can able to compute the gross profit ratio. So gross profit ratio equal to gross profit divided by net sales into 100. The ideal ratio for maintaining gross profit ratio is nothing but gross profit. That is, there is no fixed standard, but we have to maintain the gross profit ratio in a higher percentage. So whenever if you are maintaining the higher percentage of gross, it says about the it's considered as a good. So how to write the interpretation when you have a gross profit? Whenever the high percentage of gross profit ratio indicate, it says about the production is efficient, the pricing strategy used in a business is good, and also there is be a cost of control will be the cost that is effective in controlling the cost. Suppose the reverse, if it's low percentage showing a gross profit ratio, it shows about inefficient production, inefficient cost reduction, and also the pricing strategy, also poor pricing strategy. The next we'll move on to the next profitability ratio is nothing but net profit ratio. What is the term net profit ratio? Net profit ratio shows a relationship between the net profit and the net sales. In order to compute the net profit ratio, the formula is net profit divided by net sales into 100. It represents in percentage. So the ideal ratio for computing the net profit ratio, generally it's more than 10 percentage or more. When the percentage is whenever the net profit ratio is having high percentage, it says about the overall efficiency of the business is good, and also there is effectiveness, efficiency in managing the cost. These two we can say about the high percentage of net profit. Suppose in reverse, if the low net profit percentage, it shows about the overall position is not good, and also the inefficient in managing the expenses or the cost. The next we will move on to the operating profit ratio. What may I term operating profit ratio? The operating profit ratio, it measures the profit from the core business operation. So how the business operation is related to the profit. The operating profit ratio can be computed by using the formula operating profit divided by net sales into 100. So how we can compute the operating profit? The operating profit can be computed by using the gross profit plus operating expenses minus non-operating expenses. We can compute the operating profit. Or in another way, we can compute the operating profit by using the net profit plus minus non-operating expenses and plus non-operating income. We can compute the operating profit. So the operating profit shows a higher percentage, which shows about the strong operation performance of the business. So here, when you say as a when you in a real scenario, when highest operating profit ratio shows that the operation efficiency of the business comparing with the other firm is good, that we can be able to consider. The next one is return on capital employed. So this ratio explains that the how the return earned on total capital employed or the total investment made in the business. In order to compute the return on capital employed by using the formula earning profit before interest and tax divided by capital employed into 100. So the ideal ratio for return on capital employed will be lies between 15% to 20%, generally considered good. Yeah. If you say less than 50%, then it is not the return on capital employed is not good. If it's more than 20%, it's always says is a good. So here the higher the return on capital employed says about the efficient utilization of investment. So with the help of the um, uh, real-time scenario, we can explain the practical applicable use of profitability ratios. So suppose a retail company notice decline in net profit ratio. It says about the expenses or operating expenses or increase. There is a cost in the raw material and labor, and also the cost control is not efficient one. So what you have to do when in order to overcome from this, the following decision has to be taken. So we have to control the cost, and we have to negotiate with the supplier for at the time of buying raw material, and we have to revise the price. The next one will be the operating ratio. What is operating ratio? So what do you mean term operating ratio? So operating ratio shows the relationship between the operating expenses and the net sales. So this ratio always indicate how much the sales revenue is consumed by operating expenses. Operating expense nothing but day-to-day expenses which are incurred for running our business. So these expense has to control whenever we know to show our efficiency of our business. So operating ratio it measures the operating efficiency of the business. In order to compute the operating ratio, the cost of sales plus operating expenses divided by net sales into 100. The cost of sales is nothing but that is net sales minus gross profit. We can find out the cost of sales. So we along with the operating expenses nothing but the administrative expenses, selling expenses, selling and distribution expenses. So by computing this ratio, we can say about the operating ratio. So the lower operating ratio says about the operation, the expenses, the operating efficiency is not good. So we have to take care for in order to maintain the operating efficiency. So most of the profit or are eaten by the operating expenses. So we have to reduce our operating expenses and also control our operating expenses to in order to increase our operating efficiency. Mm. So in the real time example just I mentioned here, in a manufacturing company has an operating expenses ratio is 85%. It means that the turnover is 100. That is the percentage of turnover sales is 100. From the 100 revenue, the 85 percentage as spent for spent for operating expenses. Only 15 percentage is balanced for profit. This is not a good sign of maintaining our operating efficiency. So we have to increase our profit by reducing our operating expenses. So by calculating this ratio, we can able to reduce our cost and also increase our operating efficiency. The next one will move on to the return on net worth. Return on net worth is nothing but to measure the profit earned for the shareholder. or equity shareholder. How much efficiency the company using as owner fund to generate our profit. The formula for computing return on net worth is nothing but net profit after interest, tax and preference dividend divided by shareholder fund into 100. So the ideal ratio will be 15% to 20% or more will consider as a considered for most of the industry. High return on net worth says about the efficient use of shareholder fund. Low return on net worth says about the poor return to the owner. So whenever is higher says about we are using the investment and giving more return to the shareholder or the investor. If a less return on net worth says about we are giving less return to the shareholder and we are inefficient use of investment. The next one, return on asset. Return on assets means the profit generated from the total asset of the business. So how much we are using asset by based on that we are earning a return or profit. So it indicates how efficiently asset are used to earn profit. Return on asset can be computed by using a formula net profit divided by total asset into 100. So this the ideal ratio will be 5 to 10% generally considered good depending on the asset intensity of the business. High return on asset says of efficient utilization of asset. Low return we are not utilizing asset in an efficient way. So in a logistic company has heavy asset but low return on asset, it means the asset are not properly used in the business. So if we have to, it gives us signs to optimally we have to use the resources which are used in our business. The next one will be expenses ratio. Expense ratio shows up the relation between the different expenses and the net sales. So it explains about the detailed analysis about the expenses. Expenses ratio can be computed by using the formula respective expenses or individual expenses divided by net sales into 100. For example, if you want to compute the financial expenses divided by net sales into 100. If you want to compute the non-operating expense divided by net sales into 100. If you want to compute selling and distribution expenses ratio, selling and distribution expenses divided by net sales into 100. So lower ratio is a better. So whenever in the expense ratio always indicate the lower percentage that says about the efficiency about the business. Higher expense says about the higher expense percentage says about the inefficient position of the business. Next we will move on to the problem how we can solve with help of this following data by using the profitability ratio. So here they are given net sales 10 lakh rupees, cost of goods sold 6 lakh, office and administrative expenses 80,000, selling and distribution expense 70,000 and net profit 1,50,000. The first they asked to calculate the gross profit ratio. So gross profit ratio can be computed by using the formula gross profit divided by net sales into 100. But here in the question they are not given the gross profit directly. We have to compute the gross profit by using the formula net sales minus cost of goods sold. Net sales is 10 lakh rupees, cost of goods sold is 6 lakh. Net sales minus cost of goods sold, we are getting 4 lakh rupees the gross profit. Then we can substitute the formula 4 lakh divided by the net sales is 10 lakh into 100. So we are getting 40% as a gross profit. So the company earns 40% gross profit out of 100. It indicates a good production efficiency. The next one is operating profit ratio. So operating profit ratio can be computed divided by operating profit divided by net sales into 100. So here in the formula they are not given the operating profit separately. We have to find out the operating profit, gross profit minus operating expenses. So gross profit already we have calculated 4 lakh rupees in the previous formula. From that we have to compute operating expense. Operating expense in this question they are given and two type of expenses they are given in a question. One is office and administrative expenses, another one is selling and distribution expenses. So 80,000 plus 70,000 will get 1,50,000 as operating expenses here. So from this, from the 4 lakh we are subtracted 1,50,000, we are getting 2,50,000. The 2,50,000 it says about the operating profit divided by net sales. Already we have noticed that 10 lakh rupees into 100 we are getting 25 percentage. So from 100 sales we have 25% is operating profit, is showing the efficient of operation of a business. Next one is operating ratio. So operating ratio can be computed by using the operating expenses, cost of goods sold plus operating expenses divided by net sales into 100. So cost of goods sold is 6 lakh rupees. Operating expense already we are calculating 1,50,000. So total will be 7,50,000 will be operating cost divided by 10 lakh is at the sales into 100 we are getting 75%. So it refers that out of 100%, 100 the sales value, 75% we have operating, the 25% only we have a profit. The next one is net profit ratio. So net profit is directly is given in your question as 1,50,000. So 1,50,000 divided by net sales 10 lakh rupees into 100. So we are getting 15%. So it says about the 15% operate will be a profit portion, actual profit portion of our business. The next one will be expense ratio. So we have calculated different expense, office expense ratio. So the concerned expenses office expense 80,000 divided by net sales 10 lakh into 100, 8%. Similarly, we are calculating selling and expenses ratio. 70,000 is selling expense divided by net sales into 100 will get 7%. So it says about the what is the expenses, respective expenses percentage in a business out of 100% of sales. So the next we will see one more problem with related to the profit ratio. So here the question they are given net sales, cost of goods sold, administrative and net profit. Similar like a previous problem, we'll calculate what is gross profit ratio. So gross profit is not given. So we have to calculate gross profit by using the net sales minus cost of goods sold. Here 8 lakh minus 5 lakh 20,000. 2,80,000 only we can call as a gross profit. So 2,80,000 divided by net sales 8 lakh into 100 we get 35% as a gross profit ratio. The next one will be operating profit ratio. Operating profit is nothing but operating profit divided by net sales into 100. Operating profit is not given directly, so we are calculated from gross profit minus operating expenses. So here operating expense they are given 60,000 plus 40,000 is 1 lakh. Gross profit is 2,80,000 minus 1 lakh we are getting 1,80,000. So operating profit divided by net sales 8 lakh into 100 will get 22.5% as your operating profit percentage. The next one will calculate operating ratio. Operating ratio we can calculate by using a formula cost of goods sold plus operating expenses divided by net sales into 100, or operating cost divided by net sales into 100. So operating cost is nothing but cost of goods sold plus operating. Cost of goods sold is 5,20,000. Operating expense is 1 lakh. So we are all together we can get 6,20,000 divided by net sales 8 lakh into 100, 77.5%. So out of 100, 77.5% is operating expenses. So balance one we can say as a profit for business. The next one will be a net profit ratio. So net profit divided by net sales, and net profit is given directly in a question 8 lakh divided by net sales 8 lakh into 100 we can get 10%. So the next one will be expense ratio. Expense we can calculate administrative expense separately and selling and expense. Administrative expenses we have 60,000 rupees, that is 60,000 divided by net sales 8 lakh into 100, 7.5% is here administrative expenses percent. The next one will be selling expenses. Selling expenses divided by net sales into 100. Selling expense 40,000 rupees divided by net sales 8 lakh into 100, 5%. So we can calculate ratios like this. We can download the financial statement of real-time company, and we can calculate the ratios by using the formula and say about and write a interpretation to the company. So when you are doing a finance project, we can calculate, we can use one of the tool for analyzing the doing a project is nothing but the ratio analysis, and based on that you can say about the how the particular company is increased in the various ratios with respect to the with help of the ratio analysis, and based on that we can say the trend about the business. So thank you for your learning.